Let's jump right into this explainer. For years, we've all kind of thought of Cisco as the old guard networking company, right? The legacy incumbent that essentially built the plumbing of the early internet. Reliable, sure, maybe even a little predictable. But right now, behind closed doors, they're orchestrating this massive, high-stakes pivot to become a full-stack AI platform. The entire future of the company is on the line here, and all of this corporate drama is culminating in a highly anticipated earnings print on May 13th. $5 billion. Let that number sink in for a second. That is Cisco's fiscal 2026 AI order target, and it represents roughly 8% of their total projected revenue. It is literally the fastest growing line in the entire company. So when Wall Street tunes in on May 13th, this is the single most critical metric everyone will be watching. Think of it as the ultimate scorecard for their transformation. If they hit it, they own the future. If they miss it, well, the whole narrative kind of collapses. All right, Section 1, Cisco's high-stakes AI pivot. To understand the sheer scale of the stakes, we have to look at how Cisco is physically rewiring itself. Following a historic $28 billion acquisition of Splunk, which, by the way, was the largest in the company's history, Cisco has essentially restructured into 5 distinct product groups. You've got networking, their core business, posting a really surprising and incredible 21% growth. Security is growing at double digits. Collaboration is stabilized thanks to hybrid work. Observability is currently absorbing Splunk, and services saw a slight 1% decline. The reason this 5-group structure is so powerful is that they aren't just selling isolated hardware boxes anymore. They are locking customers into an entire integrated ecosystem. And here is the wild part, proving the bears completely wrong. For years, critics insisted Cisco could never escape its hardware roots. Yet, over half of Cisco's total revenue is now driven by predictable, recurring software and subscriptions. They have successfully crossed that 50% threshold. This gives them immense margin durability through those really volatile enterprise spending cycles. Honestly, their underlying business model is starting to look a lot more like a hybrid of Microsoft and Oracle than a traditional hardware vendor. Moving right along to Section 2, the $5 billion bet. So where's the actual momentum? Just look at their recent Q2 performance. Cisco delivered their best top-line print in years at $15.35 billion in total revenue. But the number that truly sent shockwaves through the industry? $2.1 billion in AI orders in a single quarter. Why does that matter so much? Because that inflection back to double-digit product growth validates that hyperscale customers aren't just politely listening to Cisco's pitches. They are actively buying into the vision with their wallets. Cisco is calling this competitive advantage their full-stack AI moat. And it's fascinating because they are the only vendor organically combining these 4 essential infrastructure layers into one offering. They have their Silicon One custom chips for high-performance fabric. They've got Hypershield, which is a brand new category of AI-native security running right in the data plane. They have Splunk for full-stack observability. And then they tie the whole shebang together with NVIDIA-validated reference architectures. Enterprises literally don't have to build AI piecemeal anymore. They can essentially just buy turnkey AI factories. And they aren't resting on their current tech either. They are aggressively pushing the envelope with next-generation custom chips, the G300 high-RODX switching silicon and the P200 deep buffer routing silicon. In simple terms, these are the heavy-duty engines designed to handle the massive, complex data traffic of AI factories without bottlenecking the system. Both of these next-gen components are ramping up into commercial availability in the second half of fiscal 2026 and into 2027. Now here is the absolute kicker, the hidden upside. These massive new hyperscale silicon products represent pure upside potential. Why? Because they aren't even factored into that $5 billion target yet. The current target relies almost entirely on existing technology. So if hyperscalers begin standardizing on this new G300 and P200 silicon, fiscal 2027 could just blow fiscal 2026 completely out of the water, creating this massive, unaccounted-for revenue stream. Let's get into Section 3, Splunk, drag, and market threats. A pivot this massive does not happen without friction. First up, the $28 billion elephant in the room, Splunk. Splunk is currently transitioning from on-premise licensing to cloud subscriptions. Naturally, this creates a temporary drag on reported revenue. It hurts their near-term optics, and management has actually flagged that this will persist into the second half of the year. But it's a very deliberate strategic trade-off. They are absorbing short-term optical pain to build a highly valuable, durable, long-term SaaS model that is going to eventually compound. Adding to that optical friction is a 1% decline in legacy services revenue. This happens because older traditional maintenance contracts are naturally running off as customers migrate toward newer subscription-based, software-defined alternatives. It's a totally expected part of the cloud evolution, but let's be real about investor psychology here. Seeing a declining revenue line on the actual earnings report definitely spooks investors who haven't fully internalized this broader transition. Then there's the fierce, multi-front war Cisco is fighting to defend its territory. On one side, you have Arista Networks completely dominating pure hyperscale data center switching. On another front, you have direct merchant silicon substitutes, things like NVIDIA's NVLink and Broadcom's Tomahawk 6, offering really formidable alternatives. And perhaps the most existential threat of all, the hyperscalers themselves. Giants like AWS, Google, Microsoft, and Meta are heavily investing in building their own custom network chips. And remember, every single internal chip they successfully deploy is permanent revenue lost for Cisco. We also have to talk about vulnerabilities. Cisco is highly exposed to customer concentration risk. That massive $2.1 billion in AI orders is heavily weighted toward just a few tech giants, like Microsoft and Meta. Any slight delay in their data center projects could make Cisco's upcoming quarters incredibly lumpy and unpredictable. On top of that, they are facing near-term gross margin pressure from industry-wide memory cost inflation, specifically the massive demand for high-bandwidth memory and DRAM components. These are the crucial chips that AI systems absolutely devour, and intense shortages are driving up costs across the board. But it's really important to highlight a massive structural advantage they have that pure-play competitors often lack: the federal moat. Their deep, historical certification footprint makes them a default trusted vendor for the Department of Defense, the intelligence community, and the Trump administration's broader AI infrastructure push. This federal moat provides incredibly sticky, multi-year revenue that is largely insulated from standard commercial spending cycles. Which brings us to the climax, Section 4, the May 13 earnings showdown. Management has set a really tight Q3 revenue guide, landing between $15.4 and $15.6 billion. This is the critical baseline Wall Street will measure them against, and there is zero room for error here. Missing the low end would be disastrous for their new full-stack AI narrative. But hitting the high end unequivocally proves the transformation is working exactly as planned. To deliver a true beat and raise on May 13th, Cisco is going to need to hit some very specific proof points. Watch closely for AI orders to sustain a heavy pace of $1.5 billion or more. Listen for any named customer wins on that new G300 or P200 silicon. They need to either reaffirm or outright raise their full-year guide. They absolutely have to prove the Splunk transition is progressing smoothly. And above all, they need to show an extension of that incredible 21% networking growth from Q2 just to prove it wasn't a blip. So we are looking at a stark divide for the stock's future, and the gravity of this cannot be overstated. The bull case is wildly optimistic. If they raise the guide, sustain the AI orders, and announce new silicon wins, we are talking about a major multiple re-rating for fiscal 2027. The market will finally reward them as a true AI powerhouse. But the bear case is equally potent. If AI orders show lumpiness, if the Splunk drag is worse than expected, or if they just reaffirm the guide without raising it, the stock will deeply compress under the assumption that Q2 was just a fluke. As we gear up for May 13th, I want to leave you with this final, pivotal thought to chew on. Has this legacy networking giant truly built a durable, compounding AI engine capable of taking on the future, or was that incredible Q2 just a temporary spike, a one-quarter wonder? Keep an extremely close eye on those AI orders. That single metric won't just define their quarter, it's going to define exactly what kind of company Cisco will be for the next decade.